If you drive a company car, your tax bill quietly went up this year, and depending on exactly what you're driving, the increase ranges from barely noticeable to genuinely significant. Let's break down exactly what changed, who's affected most, and why the answer looks completely different depending on whether you're behind the wheel of an electric car or a petrol one. We're talking about benefit in kind tax, commonly shortened to BIK, the system that applies whenever your employer provides you with a car you're also allowed to use privately, not just for work. HMRC treats that private use as a taxable benefit, calculated by taking your car's list price, known as the P11D value, multiplying it by a percentage that depends on the car's emissions, and then multiplying that figure by your income tax rate. From the 6th of April this year, the start of the new tax year, several of those percentages moved, and it's worth going through exactly what changed, rather than lumping every company car driver into the same headline. Let's start with electric vehicles, because this is where the most attention has landed, even though it's genuinely the smallest increase of anyone covered in this video. The benefit in kind rate for fully electric company cars rose from 3% to 4% this April. On a typical £40,000 electric car, that moves a higher rate taxpayer's annual tax bill from around £480 to roughly £640, an increase of a little over £10 a month. It's a real increase, worth knowing about, but it's genuinely modest in isolation, and electric cars remain by a wide margin the most tax-efficient company car option available, sitting nowhere near the percentages petrol and diesel drivers are working with. Here's the part worth understanding properly if you're currently driving electric or considering switching, because the government has been unusually transparent about where this is heading. The roadmap beyond this year is now locked in and published. 5% in 2027-28, rising by 2 percentage points a year after that, 7% in 2028-29, and reaching 9% by 2029-30. That's a meaningful climb over the rest of the decade, but even at that eventual 9% ceiling, electric remains dramatically cheaper than the equivalent petrol or diesel car, which can sit anywhere from 16% right up to 37% depending on emissions. Industry figures have specifically welcomed this multi-year roadmap being confirmed and locked in, because it means anyone signing a 3- or 4-year lease today, including through salary sacrifice schemes, knows exactly what their tax position looks like for the entire length of that agreement, rather than facing a nasty surprise partway through. Now let's talk about where the real financial impact is actually landing, because it isn't with electric drivers at all, despite most of the headline coverage this year focusing squarely on them. Petrol and diesel company cars are taxed on a sliding scale based on CO2 emissions, running from 16% at the cleanest end up to a ceiling of 37% for the highest emitting vehicles. If you're driving a diesel car that doesn't meet the RDE2 clean emissions standard, a specification most diesels registered after September 2018 do actually meet, there's an additional 4% surcharge on top of whatever your emissions band already puts you at. For a driver on a mid-range petrol company car sitting around the 25 to 30% band, on a £35,000 vehicle, that's a tax bill running into several £1,000s a year at the higher income tax rate, dwarfing the entire percentage point increase electric drivers are dealing with this year. Plug-in hybrids occupy their own particular corner of this system, and it's worth understanding because the rules here are genuinely more complex than either pure electric or pure petrol. For this tax year, PHEV rates run on a sliding scale from 5% up to 19%, determined specifically by the car's electric-only range, as recorded on its certificate of conformity, not the marketing figure quoted when you bought it. A plug-in hybrid capable of traveling over 130 miles on electric power alone sits at the lower end of that scale, while one with a genuinely short electric range, under 30 miles, sits close to the top. Here's the detail worth flagging if you're considering a plug-in hybrid specifically for its current tax advantage, because that advantage has an expiry date attached to it. From April 2028, the system tightens considerably, with hybrids in the lower emissions bands moving to a single flat rate around 18%, regardless of their actual electric range, narrowing the gap with conventional petrol cars significantly. If you're weighing up a PHEV specifically because of its current favorable banding, it's worth factoring in that this specific advantage is genuinely time-limited, rather than a long-term feature of the system. There's a cost that sits alongside all of this that drivers don't directly pay, but that genuinely affects the wider picture. Worth knowing if you're in any conversation with your employer about company car policy or fleet decisions more broadly. Employers pay Class 1A national insurance contributions on the same benefit-in-kind value your personal tax is calculated from, and that employer rate rose from 13.8% to 15% this year. For a company running a sizable fleet, that increase adds up considerably across dozens or hundreds of vehicles, and it's part of why some employers have been actively reviewing their company car policies this year, in some cases pushing harder toward electric options, specifically because the combined employee and employer tax burden is so much lower across the board. If you're supplied fuel for private use on top of your company car, there's a separate charge worth understanding too, because it operates on a completely different logic to the car benefit itself. The fuel benefit charge is calculated using a fixed multiplier, sitting at 28,200 pounds this year, multiplied by the same CO2 percentage used for your car benefit. For anyone on a higher emissions band using this multiplier, that fuel charge alone can add a genuinely substantial amount to your annual tax bill, and it's specifically avoidable if you simply reimburse your employer in full for any private fuel used, removing the charge entirely, regardless of how many miles you actually cover privately. Worth knowing if your employer currently provides fuel automatically, without you actively opting in or out of that specific benefit. Electric vehicle drivers get one genuinely useful piece of good news buried in all of this worth calling out clearly. Electricity itself isn't treated as fuel for the purposes of this benefit charge, meaning employer-paid charging, whether at home, at work, or on the public network, carries no equivalent fuel benefit tax at all. If your employer covers your charging costs, that specific benefit remains untaxed regardless of how much you're actually charging, which is a meaningful ongoing advantage layered on top of the already lower BIK percentage itself. It's worth understanding how salary sacrifice schemes fit into all of this, because they've become one of the most popular routes into a company car, specifically because of how favorably electric vehicles are treated under this system. Under a salary sacrifice arrangement, you give up a portion of your gross salary in exchange for the car, reducing your taxable income before the BIK charge is even calculated, and because that sacrifice happens before tax and national insurance are deducted, the combined saving for an electric vehicle specifically can be considerably larger than simply comparing the headline BIK percentage alone would suggest. This is exactly why electric vehicle salary sacrifice has remained the dominant company car trend since around 2020, and why the confirmed multi-year rate roadmap matters so much to anyone considering entering a new scheme this year, since a typical arrangement runs 3 to 4 years, spanning several of the rate increases we've covered. There's also a reimbursement rate worth knowing if you're claiming back business mileage in an electric company car, because it operates completely separately from the BIK system itself. HMRC's advisory electric rate currently sits at 7 pence per mile if you're charging primarily at home, rising to 15 pence per mile for public charging, reflecting the genuinely higher cost of using public charging infrastructure compared to overnight home charging. If your employer is still reimbursing electric mileage at a flat rate that doesn't distinguish between home and public charging, it's worth flagging that discrepancy, since claiming the correct rate for how you actually charge can make a meaningful difference over a full year of business mileage. So let's bring this together into something you can actually use if you're navigating a company car decision this year. If you're already driving electric, the increase from 3 to 4% is real but genuinely minor, worth noting in your budgeting rather than panicking about. And the published roadmap through to 2029-30 means you can plan with real certainty rather than guessing at future costs. If you're on petrol or diesel, your actual tax bill depends heavily on where your specific vehicle sits on that 16 to 37% scale, and it's worth running your own numbers through HMRC's official company car tax calculator rather than relying on a rough estimate, since the difference between bands can genuinely be thousands of pounds a year. If you're considering a plug-in hybrid specifically for its current tax position, understand that the favorable banding tied to electric range has a confirmed expiry point in 2028, so weigh that into any longer lease you're considering now. And if you're supplied fuel privately but don't actually use much of it, check whether reimbursing your employer directly would save you more than the fuel benefit charge currently costs you. None of this is designed to suggest company car ownership has become a bad deal across the board. It clearly hasn't, particularly for anyone driving electric, where the combined employee and employer tax position remains dramatically better than the equivalent petrol or diesel vehicle, even after this year's increase. But the headline framing of "company car tax has risen" genuinely means very different things depending on what you're actually driving. A £10 a month increase if you're electric, versus a bill running into thousands if you're on a higher emissions petrol or diesel vehicle that hasn't moved in years. It's worth ending on the practical mechanics of actually checking your own specific position, because none of the general figures we've covered replace looking at your exact vehicle and your exact tax situation. Your tax code changes to reflect your company car benefit automatically once your employer submits the relevant P11D information to HMRC. And it's worth checking your tax code directly through your personal HMRC online account, rather than assuming payroll has applied everything correctly by default. Errors here aren't rare, particularly around mid-year vehicle changes, or when moving between a petrol car and an electric one, and catching a mistake early through your own account is considerably easier than trying to unwind an incorrect tax code months down the line. HMRC's own company car tax calculator, available directly on gov.uk, lets you plug in your specific vehicle's P11D value and CO2 figures to get an exact answer rather than working from the general bands covered in this video. If this helped you understand exactly where you sit and what's actually changed for your specific situation, hit subscribe, because I'll keep covering exactly this kind of practical tax and driving information as the rest of this multi-year roadmap unfolds. Company car tax rarely makes for exciting viewing, but a few minutes spent understanding exactly where your own vehicle sits on these scales can genuinely save you a meaningful amount of money, or at least stop an unexpected number on a payslip from catching you off guard. Stay safe out there, and I'll see you in the next one.